We're busting myths about the big, beautiful bill. This is the IssuesWatch podcast. Hi, I'm Don Meyer, Chief Growth Officer at the New Jersey Society of CPAs, and welcome to the IssuesWatch podcast. Misinformation about the one big, beautiful bill was rampant even before it was signed into law on July 4th. New deductions for seniors, tip workers, and overtime, plus a tax hit on gamblers, have generated confusion, misinformation, and in some cases, outrage. TikTokers, taxpayers, and even the government itself posted articles mistakenly touting provisions that didn't make the final cut or exaggerated benefits. Joining me today to separate fact from fiction is Lauren Landolfi, a shareholder and tax department practice leader at WilkinGuttenplan. Welcome, Lauren.
Great to be here.
So I am going to ask a question that I actually got from my parents.
Okay.
So I'm going to start with Social Security. So an
Okay.
email sent by the Social Security Administration after the big, beautiful bill was signed promised that 90% of Social Security recipients will pay no federal taxes on their Social Security income. Is
Yep.
that misleading?
Yeah, so let's be specific. This bill does not include a provision that exempts tax on Social Security income. For federal income tax purposes, the laws remain unchanged. Either 0%, 50%, or 85% of a taxpayer's Social Security benefits will be includable in gross income. Now, the inclusion percentage is going to vary based on other factors, other income sources, as it has in the past. Now, you're right. The Social Security email was a bit misleading. What that email kind of covered was the total amount of Social Security recipients that don't pay tax currently and how that's going to be expanded under OB3. Specifically, as you noted, the email said that the bill ensures that nearly 90% of Social Security beneficiaries will no longer pay federal income taxes on benefits. And for those of you that are interested to see that particular email, it is available on Social Security's blog, so you can see exactly what your clients are receiving. So clearly something happened, right? And so that something is going to be a new exemption. So what this bill did is it added a new personal exemption for taxpayers age 65 and older. It's going to be a $6,000 per senior exemption. As with other provisions, there will be an income phase out. So not all taxpayers will get this $6,000 or $12,000 exemption, depending on filing status, which is important to know. The other thing, though, that's not being talked about as much is that this is an exemption. So while it will shelter some Social Security income, it's also going to be available to offset other sources of income beyond Social Security benefits. Once we're past 2028, however, this exemption will be repealed and it'll kind of fall into the other exemption categories, which will permanently be repealed.
Okay. All right. I'm going to forward that clip to my dad.
Yeah.
Yeah. All right. So it's along the lines of the friends and family questions. My next one
Yep.
actually also came from a family friend.
Okay.
And this question is about the SALT cap. So has the
Yep.
SALT cap been raised to $40,000 for single filers or just $40,000 for married filers?
So the $40,000 SALT cap is applicable to all taxpayers regardless of filing status. So that $40,000 cap is going to be available for single filers, joint filers. Additionally, that cap has a 1% increase each year. So next year we'll get 40,400, we'll get 1% over that in the following year, and so on. Now, again, we have phase outs. The phase out for the SALT cap is going to start at $500,000, and the phase out range is going to be reduced by 30% of the excess over that $500,000. Now, if you're married filing separate, we'll cut that in half. That phase out is going to be $250,000. That's where we'll start. Let's just walk through a quick example just to put some numbers. I know we're talking to accountants here.
Right.
So let's say we have a couple, their modified adjusted gross income is $550,000. Because they're married, we'd be looking at that $500,000 SALT cap. And so we have $50,000 excess over that modified adjusted gross income threshold. And so now we're going to take 30% of that $50,000 or $15,000. That's the amount of the reduction on our SALT cap. So that taxpayer will be entitled to a $25,000 maximum SALT deduction, not a $40,000 max deduction. The other thing to note is that there is a floor. So the taxpayers that are completely phased out of the SALT benefits aren't going to be phased down to zero. They'll still be entitled to that $10,000 that we've historically been getting over the past few years. Now, the other thing to kind of watch here is effective dates. This particular provision is retroactive. So this SALT cap expansion is available now for tax year 2025. We'll have this available with us through 2029, at which point everyone will be back on level playing field with a max $10,000 deduction.
Okay. And here in New Jersey, I know after the SALT cap was put into place, and there was a lot of concern about that from taxpayers and from CPAs.
Absolutely.
They made some adjustments here in New Jersey where we were able to get a deduction for property taxes. So what New Jersey does is still to be determined, correct?
Correct. So everything we're talking about is federally. The devil, again, is going to be in the detail. And as we go, we'll probably see some more discrepancies between federal and state taxable income.
Okay, all right. So we'll do another podcast when New Jersey
There
decides what
you,
they're going to do. Yeah.
there you go. We'll see.
Yeah. All right. So our next question is really, I guess, kind of targeted at hourly workers. What do they need to know about? And I'm intentionally putting this in air quotes, no tax on overtime and tips. What do they need to know about
Yeah.
that?
Yeah, so with both the no tax on overtime and no tax on tips provisions, these are both two new deductions that are being enacted for tax years 2025 through 2028. So the taxpayers' W-2 Box 1 wages are going to remain unchanged, but now they'll be entitled to take an additional deduction, assuming they meet the income limitations as with other provisions. The other tricky thing with this one is this is going to be available for all filing statuses unless you're a married taxpayer filing separate from your spouse. These deductions are not allowed on separate returns. Now, let's get into specifics. So, the tip provision specifically is a $25,000 deduction per return. So, you heard that right. A single taxpayer and a married taxpayer will still be entitled to that same $25,000 deduction. Now, this is going to be available for cash tips, so tips that are paid via cash, credit card, Venmo, those traditional cash methods. And it's also going to be available for where the tips are customary in that taxpayer's industry. Now, what is customarily tipping industry? Who knows? One of the items that needs some more clarity from the Treasury is really defining what's a qualified tip and what the expectations are. So we're going to need a little bit more info here. If we switch gears and talk about that overtime deduction, this works a little differently. So this deduction is a $12,500 deduction for a single taxpayer or a $25,000 deduction for a married taxpayer. Now, this specifically is going to refer to the premium portion of the overtime, which is the amount that exceeds the employee's regular rate of pay. So again, I'm dealing with accountants. Let's talk through an example. For an employee that earns $20 an hour and their overtime rate is $30 an hour, so they're earning time and a half. Only that $10 premium is going to be the amount that's calculated as overtime pay, not the full $30 overtime rate that's being paid. Now, there's a few other notes just with respect to these two particular provisions that are going to be important. So the deduction is going to be available regardless of whether taxpayers itemize or not. So this is going to be great. It's going to be available for single taxpayers. The phase-out range starts with modified adjusted gross income at 150. It's going to double that for married taxpayers. So married taxpayers, that phase-out is going to start at $300,000. And the deduction is going to be available for the current tax year, which sounds great in theory, but that's going to be a little tricky. If we look at the date, today we're sitting here 2 weeks post enactment, and so it's July 17th. And so We're 7 months through a year. And so withholding has been paid in on these overtime amounts so far this year. Employers have not done any reporting. It's going to be a little hairy, I think, as we go through. So, from a worker's pocket standpoint, we're probably not going to see too much benefit for this one until next year in April, as taxpayers are receiving their refunds. And again, let's go back to the beginning. This is a deduction. Box one wages are remaining unchanged. And so who knows what states like New Jersey are going to do and if they're going to conform to these new available deductions. You only asked about the worker. The employers are going to have a whole lot of fun to get through as well.
And I was going to make 2 points. One is you're mentioning a lot of these provisions that were in the legislation, but CPAs and the public are still waiting on guidance from the IRS for a lot of these. Is that correct?
Absolutely. So the bill has a 90-day Treasury comment period. So we're expecting something from the Treasury by October 2nd. I think that's that official date. And then the normal forms will have to be produced. So it's going to be an interesting few months.
Yeah. And I remember after the Tax Cuts and Jobs Act was passed, one of the
Mm.
recommendations that CPAs made and the NJCPA made was that workers should take a look at their W-2. Is that something?
Absolutely.
Absolutely. Okay. So, but maybe not now, maybe wait until some of those comments come in and the guidance comes in from the IRS.
Yeah, at this point, I think everyone's waiting as to what this is going to mean next steps. We're all kind of on pins.
Right. Yeah, and I can imagine.
Yeah,
Um, so with any piece of legislation, there's always, I guess, depending on where you sit, good news and bad news.
for
So
sure.
there is some good news for taxpayers who give to charity. So please explain the changes to the charitable deductions.
Yeah, there is good news on the charitable front. And what's cool about this one is that we see benefits on both sides. The charitable expansions are both for itemized deduction taxpayers and non-itemizers. So specifically, OB3 reinstated the below the line charitable deduction for non-itemizers, excuse me, that was enacted during COVID. So it had been, if you recall, that $300, $600 above the line charitable contribution deduction. What OB3 did is it reenacted that above the line deduction or below the line deduction, excuse me, and it made it permanent. In addition to making it permanent, it expanded that deduction. And so now that deduction is $1,000 for single taxpayers or $2,000 for married taxpayers. Now, like the original provision, it is a narrower charitable contribution deduction, so it's only going to be available for cash contributions that are made to public charities. So good news for non-itemizers that are charitably inclined, and also good news for itemizers that are charitably inclined, because that 60% AGI limitation was made permanent. So now, again, those altruistic, charitably inclined individuals have more room to give tax efficiently. Now, there is a little not so good on the charitable side for itemizers that are high income taxpayers. We did get a new floor on itemized charitable contributions, and that floor is 0.5% of modified adjusted gross income. So, taxpayer with $100,000 of gross income, 0.5% phase out, that first $500 is going to be disallowed. Um,
Okay.
and as well, we also have an overall itemized deduction limitation that came into play, kind of a resurgent of the P's limitation. And so again, those higher income taxpayers may see a little bit of haircuts on their itemized deductions, but overall good stuff here.
Okay. And in general, probably good news for charities too, because
Absolutely,
I believe contributions went down after the charitable deduction went away. So good news for generous people and for charities as well.
for
Yeah.
sure.
Now, unfortunately, gamblers took a bit of a hit with this legislation. Please explain the gambling provisions that some lawmakers are already trying to repeal.
Yeah, so the gamblers didn't make out quite as well as some others in this provision. So historically, gambling losses used to be deductible to the extent of gambling winnings. So you could bring yourself down to zero, but you couldn't go below zero. What OB3 does is it adds a new limitation. And so now gambling losses are only deductible up to 90% of taxable income. So again, we have a taxpayer historically they had $100,000 of gambling winnings, $100,000 of gambling losses. They used to be tax neutral, no taxable income. Now that same taxpayer can only deduct 90% or $90,000 of their losses, and now they will have $10,000 of taxable income. This is effective in 2026. So next year, we have a little bit of a delay. Now, unlike the SALT cap expansion, unlike the senior personal exemption, which were both temporary provisions, this one's permanent. So this is definitely going to be a big deal for our professional gamblers.
Right. Permanent unless lawmakers act to repeal it, right?
Yeah, well, everything's permanent for as long as it's permanent.
Right,
But
exactly.
there's no end date written into the law. And honestly, sometimes when there's no end date, it's a little harder to get them gone, right? I was a little suspicious whether or not we would really see that SALT cap go away once we had a limitation. And we're not getting SALT the way we used to. So we'll see. I think all of us maybe should polish up our crystal balls and see what happens.
Yeah. I have to admit, when I also, your example of $100,000 in winnings and 90,000 in losses, or 100,000 of each.
Yep.
I read that also, and I confess when I read that, I had a heart attack. I was like, $100,000 in gambling losses, and I realized we're talking about professional gamblers. We're not talking about somebody goes to Atlantic City one weekend a year. But I was like, oh my God, I'd have a heart attack if I lost $100,000.
For sure. You'd be surprised at the number of W-2Gs that come through in a season. So I think this might be a little bit more impactful than everyone realizes.
Yeah. All right. So for the last question,
Sure.
we've covered a lot of ground,
For
but I'm
sure.
sure there's things we haven't covered. So can you pick a particular change or changes that are under the radar that you think deserve more attention?
Yeah. So honestly, in preparing for this podcast, I'm wondering if the divorce attorneys will be more busy than others given some of these marriage penalties.
Yeah.
But for me, again, we're 2 weeks post enactment at this point. All of us are trying to get our arms around those big shiny new toys and what's going to be most impactful for our clients. For me personally, here we are sitting in the tri-state area where AMT has always kind of been a big deal for us. TCJA made it less of a big deal, but there are some AMT provisions in this bill that I think might be a little sneaky. We did get a permanent hire repeal as part of this bill, which sounds like good news, except that a permanent hire exemption as part of this bill, except that the way that the laws are written, it's a little tricky. So in 2026, our maximum AMT exemption is going to be $1 million. But in 2025, we're at like $1.3 million. So that permanence actually is a reduction when compared to what we're at currently. In addition, the AMT phase out range went from 25% to 50%. So for every dollar your AMT exceeds the phase out threshold, your exemption amount now is going to be reduced 50 cents instead of 25 cents on the dollar. So what does that mean? The 2026 AMT exemption is going to phase out at lower income amounts, and it's going to phase out twice as fast. So we've not done the math internally to really see where those breakpoints are, but I think AMT might be a little bit more prevalent as we go into 26 and beyond based on the way these laws are written. But we'll see. Time will tell.
Yeah, I think I consider AMT sort of like a zombie. I haven't heard AMT in so long. I thought
Yep.
the Tax Cuts and Jobs Act more or less killed it, and then all of a sudden it came back up.
We'll see what happens, but that's what we're going to be watching is how AMT is going to expand potentially under these laws.
Great. Well, Lauren, we'll leave it there. This has been so much great information. We really appreciate it. Thanks again for joining us today.
Thank you so much for having us. We'll keep you posted as we learn more.
Great. Thank you. Thanks for listening or watching. For more events, articles, and resources on the bill, visit njcpa.org/hub/BBB.